That meant we went from the old originate and hold model, where somebody makes a loan, holds it, cares about the risk, to the originate and sell model. And if you originate and sell models, you don't have a lot of incentive if you're an originator to look at the risk. That ended up creating some perverse incentives. It started out as sloppiness, probably ended up fraud, a kind of problem that's very difficult to deal with. An individual comes in and said, you know, I made $60,000 last year, but last year you really made $50,000. Broker says, well, didn't you really make $70,000? Because if you made $70,000, I can get you a bigger house, and houses always appreciate. It'll be a great deal, leverage yourself up. Lots of perverse incentives. And then, of course, Standard & Poor's, Moody's and Fitch, government sanctioned entities, misrated all this stuff. And this is when the investment bankers jumped into the process. They were very creative, created lots of instruments. Freddie and Fannie made the market happen. They siphoned off part of the market into the capital markets globally. A lot of people call this greed. A lot of discussion has been about greed. A lot of these people lost their jobs and lost all their wealth. I don't think greed's the right word. I think it's dumb and pragmatic. Dumb and pragmatic is a good word. By the way, it's kind of a weird theory to say we just had a sudden spike in greed on Wall Street. We never had it before. I mean, I think we had whatever greed we had it all wrong. Little esoteric stuff. It's a little complex, but I'm going to try to simplify this idea. You hear about these complex credit instruments, one of which is the CEOs, credit default obligations. These were actually legitimate inference ideas that got perverted. The way CEOs started, a bank makes a $500 million loan to General Electric. Doesn't want to hold all the risk, so they keep $100 million worth of the loan and sell $400 million in the capital markets. Legitimate idea. Investment bankers took this idea and focused it on the residential real estate market. They were originating lots of these home mortgage things, and they wanted to sell them into the marketplace. They said, well, you know, if we had more variety, it'd be easier to sell and make more profit. So they said, we've got this portfolio, I'm going to make it simple, of B-rated mortgages. If we tranche this portfolio, we can end up with some A's, some B's, and some C's, and there are people that would rather buy A's, B's, and C's. And the way we'll do that, we'll subordinate the C's, so any first losses go to the C's, and then the next set of losses go to the B, and then you never get to the A's and B's, and you'll get to the C's and B's, and then the A's will take the last losses. Sounds like a legitimate idea. Here's the problem. The A, B's, and C's weren't A, B's, and C's. They were D minuses, F, and F minuses. So the ratings were well. And then secondly, the investment banks got either stupid or greedy. You pick your choice. They had these A's, B's, and C's. They were selling them and making money doing that. Bernanke inverts the yield curve. No margins in the traditional banking business. The only thing you can hold and make a profit is the C's. The high-risk instruments had high rates on it, right? And the Fed and everybody else is saying the economy's going to do wonderful forever. So they say, well, these C's, the rates that are paying on them were very attractive. Instead of selling the C's, let's hold them. Let's hold them. And then, of course, what happened when the market started coming down, the C's, they lost 100 cents on the dollar. You remember Merrill Lynch was making a fortune before they went broke? They were making a fortune, selling A's and B's, holding the C's, and then, of course, they went broke because of C's, they lost 100 cents on the dollar. Part of the other capital markets things you hear about, credit default swaps, which sound esoteric, but all they are is an insurance policy. And here's the idea. Goldman Sachs has a portfolio, for whatever reason, of B-risk mortgages. They want to make them A's because the SEC requires them to have less capital if they're an A. And if they can combine the B-risk and the insurance policies not too much, they can actually afford to hold some of these and quote, sell them in the future. So they go to AIG, which just insures what's called a tailwind risk on these policies, the ultimate payment on these policies. A legitimate idea. AIG, a couple of problems. One, they did a terrible job themselves of rating these things. And second, they were relying on the rating agencies. So that all these A, B's, and C's weren't, they were D's, F's, etc. in that regard. The interesting thing about this kind of instrument is what was happening in the capital markets kind of at the end of the cycle. You really see this kind of classic stage with Bear Stearns. AIG started having noise in the marketplace. They were AAA rated, but people knew that there were problems in the default market. They were having losses. And the credit default swap market basically is a very thin market. And once AIG got out of the market, there was no market makers kind of on both sides of the market effectively. So some smart hedge funds said, okay, a lot of people in the stock market look to your insurance costs to determine how risky you are. So if your insurance price is going up, your credit default swap's going down, people think that you're riskier. So why don't we, it's a very, legally, you can manipulate the credit default swap market because it's those at the end with AIG out of the marketplace, and at the same time, once you short Bear Stearns. So you make the credit cross swap market look worse, insurance price goes up, you even take some losses on that, but you make a lot more money as you shorted Bear Stearns. And the SEC, by the way, wasn't enforcing what they call the naked shorting rule where you're supposed to have stock. So a lot of hedge funds were manipulating in this regard. Some of them, by the way, when this thing flipped, a lot of them got caught. That's why Harvard and some of those people had some big losses in their endowments. One of the reasons they got caught in that. One of the interesting questions, why do we save AIG? If you look, AIG is a huge insurance provider, and you can argue about the system risk if the insurance subsidiaries have failed, but the insurance subsidiaries were very well capitalized, were in excellent shape. The problem was in the parent company. So we really weren't saving the insurance operation, we were saving the parent company. The theory of that was what's called a counterparty risk. Now, interestingly enough, one of the big counterparties to AIG was Goldman Sachs. And Paulson came out of Goldman Sachs, and everybody at the Treasury came out of Goldman Sachs. Well, if you spent your life in Goldman Sachs, you can honestly believe that if AIG goes down and takes Goldman Sachs out, that's going to create a systems problem. Might be, or it might be crony capitalists. Make your own judgment on that. One interesting thing, read a lot about the incentives to the people to stay at AIG. If you actually look at the amount of money involved, it was trivial compared to the interesting thing we did. The other big counterparties to AIG were European banks. By saving AIG, we saved billions of dollars of losses in European banks. Interesting decision. Really big concept, and that was the banking industry was deregulated. That's absurd. The regulatory environment during the peak of the bubble was the worst in my career. We were just misregulated. All the regulatory energy was focused on Sarbanes-Oxley and the Patriot Act. Now, Sarbanes-Oxley is a law to theoretically prevent fraud. Well, the Banking Act had Sarbanes-Oxley going back to 1990 with the thrift industry. So we had a redundant system on a redundant system. The Patriot Act is where we're supposed to catch terrorists. That sounds interesting. The banking industry spends $5 billion a year on the Patriot Act. You know how many terrorists have actually been caught and convicted because of the Patriot Act? None. You know how many are going to be caught and convicted? My prediction is none. What's the odds of one of our tellers catching a terrorist? And if we did catch one, you think we might call somebody and say, there's a terrorist here. Interesting. Underlying the regulatory structure that was non-trivial was a very fundamental belief in mathematical modeling. And it was driving how you were supposed to manage risk. And by the way, the Fed's mathematical models all failed. The Fed did not predict this recession, right? And they certainly didn't predict a recession of this magnitude. So all these mathematical models failed. But we were told over and over again, if we just had wonderful mathematical models like Wachovia, which failed basically, or like Citigroup, we'd be in great shape. There's a huge focus on mathematical modeling. You remember, interesting thing, remember when this crisis first started, the people in Europe were kind of laughing at us, and then all of a sudden all the major European banks failed. And the reason for that, the European banks had adopted Basel. Basel was an international agreement that determines capital in banks, and you use mathematical modeling. So the European banks had no capital. So when they started liquidating down, they got in trouble really, really fast. Now, mathematical modeling can be a helpful tool, but there are two basic problems with it. One, they all have what they call tails. They assume normal curves, and they have these tails. What happens is the tails are always bigger than reality, because if you do a mathematical model, you don't want a big tail, so you keep making assumptions so you don't have a tail. And these tails can kill you. It's the thing I say to people, that if you build a house in a 100-year floodplain, the bad news is you are going to have a flood. And these models have actually, in some ways, predicted the floods. They put low probabilities on them. The second thing is you cannot model human behavior, particularly under stress. So none of the models predicted how people would act in a stressful environment.